So, wonderful good morning. Last content lecture, monetary policy is today's topic. So, when we talk about monetary policy, the main institution there is, of course, the Reserve Bank of Australia. That's Australia's central bank. And we talk about the cash rate. That's the one that is frequently announced as their cash rate target and how they save. If they want to supply more money or less money to the economy, if they want to make it cheaper or more expensive. They're the ones that can issue notes and coins and create new exchange settlement funds. They're also the banker to the Commonwealth government. They're in charge of the stability of the financial system. So if one bank is in need of liquidity, the RBA can help out. And they're also involved in the regulation of the payment system. Now the red ones are the ones that I want to focus on today. Some reading, so we're not necessarily sticking to one textbook here, because these textbooks are of course American textbook. The theory is the same. By and large, everything is going parallel. Just instead of cash rate, they call it, for example, in the American textbook, federal funds rate. Instead of repo rate, they sometimes talk about a discount rate. But the ideas are exactly the same, so you can read American textbooks. But I reckon it's fairly useful to read across these possibly as well. Here, RBA monetary policy. They have, I would say, 2 or 3 pages on it. It's fairly detailed, but still easy to understand. And the same for open market operations. I think that gives you a good insight, especially in combination with our slides. And we want to talk a bit about quantitative easing towards the end too. There's a fairly good Economist article for that one available. Good, basically covered this one already. So, very important to me, while the RBA is of course an Australian institution, and the governance of the RBA are implemented by the Australian government, I still would see it somewhat separate from the Australian government. You should always separate between monetary policy and fiscal policy. Fiscal policy is what you talk about in macroeconomics and also in public economics and public finance a bit. But we want to focus here on monetary policy. And monetary policy, even though sometimes in the newspaper you read that the government is deciding something about monetary policy, it's really the domain of the central bank. And the central bank is independent of the government, at least in Australia, the US, and Europe, and most developed countries. So the central bank is basically doing monetary policy by setting interest rates, affecting the money supply, and therefore also the exchange rates. The objective, according to the Reserve Bank Act in Australia at least, is basically to keep the currency stable, to maintain full employment, and to improve overall economic welfare and prosperity for the Australian people. Now, sometimes these objectives are going in opposite directions. For example, if you want to maintain full employment, do you want to pump lots of money in the economy or little? For businesses, if money is cheap and interest rates are low, or if interest rates are high, it's hard to get credit. Money is cheap. But if money is very cheap, what might happen to inflation? It goes up. So sometimes these objectives are contradictions, so the RBA has to strike a balance. But by and large, I would reckon stability of the currency is a major task here. And they are aiming for low inflation rates, 2 to 3%. So they don't want to have 0% inflation, slightly positive inflation, but not very high. A little bit more detail. Basically, they said later on the objective is to keep consumer price inflation between 2 and 3%. So we don't look at share price inflation or house price inflation, because when you saw in Australia, house prices are moving up quite fast over the last few decades. But the RBA is looking at it, but it's not really what they're targeting, house prices. What they're looking at mainly is consumer price inflation, and also they look at the average over the cycle. So if in one quarter they have inflation rates of 5%, they don't start panicking and increase the interest rate immediately. So they look at kind of an average over a certain amount of time. Altogether, this policy is also stabilizing the economy for short-run fluctuations. And inflation target is the #1 objective. So it's for the third time now, 2 to 3% is the target. So why do we care about inflation? Good. Why should we care about inflation? Just a little bit of a reminder. You had something similar in macro, I think. The easiest way to see why inflation is trouble if you look at countries that have extreme amounts of inflation. So in the past in Germany we had very high rates of inflation. So this is just like a price index. For example, something might have cost $100 or in this case 100 Deutschmark in 1921, 22, a little bit more, so a little bit of inflation is normal, right? But look at this one, from 22 to 23, something that was maybe $120 here, sorry, D-mark here, all of a sudden 10,000 D-marks. And 1 year later, I can't even say that number, right? So you can see prices are just going through the roof. In Zimbabwe, 2008, they had a similar thing. Prices doubling every 2 days. So imagine if you get paid, right? You've got to spend your money immediately, very quick, because otherwise everything gets more expensive, twice as much, so you can buy only half as much. So basically money became totally worthless. Look at the numbers here. So in order to buy 3 eggs, they need 100 billion Zimbabwe dollars. Unfortunately, 2 days later, you can buy only 1 egg with $100 billion, right? And you can imagine by the end of the week, you can't buy anything. So in this example here, this one also important, of course, so people really didn't want to have Zimbabwe dollars anymore. They tried to switch it against something, either against eggs, US dollars, euros, against something more valuable, something that keeps their value much better, right? Look at these things. So I think, just if you look at these numbers, the economy is of course not working very well anymore, right? If you go, for example, with your wages now shopping, and your shop is saying, listen, the eggs cost now $110 billion. It's very hard to tell if this guy is trying to trick you and is increasing the price of his eggs by 10%, and you can still get eggs somewhere else at $100 billion, or if that's still a good price. And if we go shopping, for example, I buy a lot of milk, I know 1 liter of milk, pretty much $1. So if it costs $1, it's fine. If it still costs $1.20, it's fine with me too, right? But if it's $3 or $4, well, it's better be some kind of magic milk, right? But I've got a pretty good idea if it's worth buying or not. In countries like these, you don't have a good idea at all. Because maybe if you go to the next shop, because it takes time, it might take 10, 15 minutes, and prices rise so fast, in 15 minutes they might rise by 20 or 30% again. Right? So you don't know if the guy that sells you the stuff, that offers you something, is giving you a good price. You have not the slightest idea. And with eggs, of course, it's a very simple example, but it's not only eggs, right? You have to buy all kinds of stuff. Not only you have to buy a lot of things, businesses have to buy a lot of things too, right? If you're a car producer and you want to buy wheels for your cars, and you have inflation rates like this, it's very hard to find where should we order your wheels from. You can't even compare the price anymore, because by the time you pick up the phone, all the prices changed again. So the economy can't run with high inflation rates like this. Just figuring out really, like these numbers themselves are so puzzling, I reckon you can't even figure out what's going on there at all. Good, so we had that in Germany, we had that in Poland in the past, and we had that in Zimbabwe. Now, where does this one come from? I think the simplest explanation is if the government is printing too much money, right? So if the government decides, well, $100 bills are not good enough, we should print a few $100 billion bills, then we can pay off our debt much easier. We can buy new government buildings, we can buy tanks for our military by printing all this new money. Well, then you get more and more money into the economy. If you have the same amount of goods, but more money, prices are going to start rising sooner or later. Right? That's the basic idea of the quantity theory of money as well. So I find this a very useful thing to keep in the back of your head. Too much money hunting too few goods. That is causing inflation. And there we can see too why in America, before the global financial crisis, we had a large expansion in loans and deposits. So there was much, much more money. Also, since the global financial crisis, the US Federal Reserve Bank issued a lot of additional money too. So there was much, much more money coming into the economy. Did the US had hyperinflation like this? Did prices go through the roof in the US? Not that I'm aware of. Right? So the inflation rate themselves kept fairly steady. Now, how can we put these two together? Well, if you have a lot of money, but people don't spend it on goods, if people simply don't spend that money, then there's no reason why prices should rise. Right? Or say it slightly different, in the US before the global financial crisis, people might not have spent all that money on clothing, eggs, apples and food and restaurants, but what did they spend a lot of money on? Housing. And what happened to house prices? Remember from last week? through the roof, skyrocketed, right? So they had house price inflation. Some people argue we might have something similar in Australia. I'm not saying that we have, but it's something to keep in the back of your mind, right? So just the fact that there's more money around doesn't necessarily mean that we can see it in consumer prices. We might see it somewhere else. We might see it in share prices, house prices. Maybe people just want to have more liquidity and leave it under the pillow at home. Then we don't see it in any prices. So there's no fixed link between the amount of money and inflation. But there's a loose link. If we have way too much money printing, most likely we get inflation. Inflation has several negative side effects. Let's start with this one here. That's a bit the hardest one. Interaction with the tax system. Let's say you're earning $50,000. That's a decent amount, but you're not extra rich. So you get taxed, I'll make a guess, 25%, let's say. And now we have lots and lots and lots and lots of inflation over several years. Inflation means all the prices rise, but what's happening to the wages? All the prices are rising, wages should rise too. So everything is rising. So I'm not talking about sticky wages right now. Just think of long periods of time. So the wage rises, the price rises. So instead of earning 50,000, you earn 60, 70, 80, 100,000. But you're not getting any richer because everything else increased in cost as well. But here's the tricky part. If the tax system is not inflation indexed, according to the tax system now, you earn 100,000, that makes you a rich person. And rich people have to pay higher tax rates. So your tax rate is increasing. Right? And that would be, of course, not really what you wanted to do, because you actually didn't get any richer. You just looked richer on nominal terms, but not in real terms. So that's one problem. Next problem is also with the interest rate itself. We can make a similar argument here. So if you have interest rates, your interest rate income is of course taxed. Let's just do a very simple example. Let's say you earn currently 4% interest, and to make the calculation easy, the tax rate is 50%, and we have zero inflation. Let's think how much we really earn then. So you get 4% interest, half of it is going to the government. So how much is going into your own pocket for each $100? $2, yes, that's where I'm thinking too. So for $100 investment, you get $4 interest, $2 going to the government, 50%, $2 in your own pocket, so you made 2% real return. Now let's put inflation to it. Let's say we have inflation rates of 4%, and I'm going to do that on paper. The nominal interest rate should be some kind of real interest rate plus inflation rate. So in my example, I just say for you the nominal interest rate is going up to 6% to be nice and easy. Nominal. So this looks okay, right? So we've got 6% nominal interest rate, 4% inflation. That means we should have real in our pocket, again, 2%, just like beforehand. But tax is calculated not on the real interest rate, but the nominal interest rate. So now we can think what happens now. So we get 6% nominal. Interest. But half of it is going to the government, so that means we're getting only 0.5 of that. Nominal. So that means we get after tax 3% nominal interest. Everybody on board so far? Good, but that is nominal returns. We actually want to know the real returns. What do I have to do now to calculate the real return? Real interest equals nominal interest minus inflation. For example, 3% minus 4% inflation minus 1%. So that's not very good. And you can see that's basically coming in from the tax, because the tax is taxing a nominal interest rate. Count that the real return that we have in this situation is actually not 6%, but it's only 2%. So they took away too much taxes. And that is what they've meant as one of the negative side effects over on the slides of inflation. So inflation is distorting all these prices here. So that means if we are receiving interest, we are now being taxed too much if we have inflation. But if we are paying interest, for example, on a mortgage, and if you are negatively geared, you can use these nominal interest payments to deduct from your tax. And in that sense, the deduction would be too high. So if you invested in money, in a monetary asset, you're getting extra punished now with the inflation and with the tax. If you borrow money, with the inflation and the tax, it's actually an advantage for you. Right? Either way, together with the tax system, things get very messy if you have high rates of inflation. Then there's also uncertainty. So you've got a feeling for how much something should cost. For example, I buy a lot of milk because I like to drink coffees and eat cornflakes. So I've got a pretty good feeling about milk prices. $1 per liter is usually quite good. $1.20 is like, okay, if it's some kind of brand. And $1.50 or $1.60 for a liter, I consider a rip-off. But now let's imagine if you're living in a country where prices are rising all the time, where very high rates of inflation. Let's make it 20, 15, 22% each day. Now if I'm going to the shop and the milk costs $1.20, I don't know, is that because this shop is expensive? Or is it because all shops increase their prices by 20% today? So I don't know if, what I'm facing there, what kind of price I'm facing. Is it a relatively high price, or is the high price only high because of inflation? And that makes all kinds of business harder. Just think of all the decisions that you do every day. Businesses that go shopping every day for their inputs. If they can't tell anymore which is now the cheapest producer, because all the prices change all the time. That's getting very messy, and the whole economy is then not running smoothly anymore. Distribution effects, so people that have cash holdings, let's say, for example, if you have your money in the bank, in the savings account, and there is high rates of inflation, the real value of the money is going down. You can buy less now with that money. If instead of having the money in the bank, you invested the money in houses, what's happening to house prices if you have high rates of inflation? Wages go up, prices go up, house prices also go up. Similar with shares, so all real assets, their prices go up. So there's redistribution between people that save in money and people that save in real assets if you have high rates of inflation. Good, so all these would speak for that we should aim towards 0% inflation or very, very low rates of inflation. But here's one reason why slightly positive rates of inflation are good if you have 2 or 3%. And the reason basically relates to what you were pointing at beforehand with the sticky wages. So people are really, really, really resistant to lowering nominal wages. Nobody wants to take a nominal wage cut. People get very grumpy if that happens. But the economy is constantly changing and our productivity is constantly changing, and sometimes it's just not appropriate anymore. Let's say, for example, the Australian car industry, that we have high wages from the past because international competition changed or technology changed, and now if wages are sticky, we can't reduce them. That means we just have to lay off people. But if we have small rates of inflation positive, instead of laying off, if we're waiting a little bit and keep their nominal wages constant, what happens to their real wages? They're going down. Yes, we pay them $50,000 each year, but the $50,000 real value due to inflation becomes less and less and less because we can increase the car price, we can increase the price of all the products that we're selling, but we leave the nominal wage fixed. So in that sense, people often say that low levels of inflation are a little bit like grease in the gearing of the economy. It helps to readjust prices everywhere, because nominal prices themselves are rigid. So the RBA is looking at all these things and makes a decision if it wants to fight inflation or is relaxed about the inflation. First Tuesday every month they're meeting, and it's always big news. So the days beforehand they're always speculating in the newspaper, will the interest rate go up, down, stay the same? Everybody is putting in their 2 cents. And then on that Tuesday there's a meeting in the morning, and at 2:30 it's published what actually happens. And beforehand it stays an absolute secret. And these decisions are independent of the political process. As I said beforehand, monetary policy and central banks are independent of the government. And that has turned out to be very, very important. Because just imagine if the government, if Kevin Rudd or currently Malcolm Turnbull can decide how much money to print. And we're coming towards an election. What would be the temptation? Lower interest rate, print more money. So two sides of the same medal, just give it to the people and then they're happy. Now that would cause huge amounts of inflation, of course, and politicians are not stupid. So after you won the election, what would you do then? Increase interest rates. So before the election, interest rates down, print lots of money. After the election, immediately interest rates up. And we can see that can't be good for the economy if we have this much volatility. That is destroying any kind of basis for planning and for your long-term investment. That's the reason why we keep central banks independent of politicians. Good, the general target is the cash rate, and currently the interest rate is 1.5%. You can look that up here. Transparency. Nowadays, the RBA is publishing its minutes. That basically means that they're publishing what they were talking about in the meeting and why they kept the interest rate constant, or why they increased it, or why they decreased it, and what they're thinking about the future. The Fed in the US is doing the same, and I think the ECB as well. And that is different to how it used to be in the olden days. In the olden days, they were just meeting more or less secretly, and they never said why they changed the interest rate. In fact, in some countries, they didn't even say that they changed the interest rate. They just did it in the markets without telling anybody about it. So nowadays, it's much more transparent. And one of the reasons for this one is they want to give everybody in the economy a little bit of guidance if you should spend more or less. For example, if you have too much inflation, do you want people to spend more money or less money? Too much inflation means there's price pressure, that all the prices increase. So if you are the central banker, what would you prefer? People spend less money. So you can either do it by forcing them by cranking up the interest and make life really hard for them, or you can just say, listen, I see there is high rates of inflation, I'm going to increase the interest rate, or we see that the interest rates are going to be on the rise. And when people hear that interest rates are on the rise, are they becoming more thrifty or spending even more? More thrifty, because they are worried that the cost of credit and everything else will be more expensive. So people start saving more. So just by communicating, they can influence the economy already a bit. And that's the reason I reckon why they're nowadays much more transparent.